Hi, everybody. Welcome to the Investor's Guide to Thriving. There's a lot going on this week. We're just days away from the US election, and it's turned into a coin toss. No stimulus bill now until we figure out who's running the show, and most importantly, the Senate. And the second wave of COVID is most definitely here. We're seeing a return to strict lockdowns in several European countries, and the uncertainty spilled over into markets, dampening the relentless enthusiasm that's pervaded since the spring. A couple headlines at the close today. Looks like Apple sold a few less iPhones in China than expected. And according to futures, markets don't like it. And then I just saw a note from Bloomberg that billions of dollars of US relief funds intended for small businesses were claimed by scammers in Russia and Nigeria. Turns out that Nigerian prince finally convinced someone to send him money. Well, I'm not sure if all that makes you want to laugh or cry, but hopefully you'll be happy to hear that we've got a few more of these webinars scheduled. Each Thursday at 7 p.m. Eastern Time through December 3rd, you can get your fix of Larry in between episodes of Berman's Call, which has returned to its usual time of Mondays at 11 a.m. Eastern. We hope you can make time to help Larry and I support childhood leukemia research at Sick Kids and Alzheimer's and dementia research at the Baycrest Foundation. If you'd like to make a donation, please use the links in the survey you'll receive after the event. This is not only your opportunity to tell us how we've done on tonight's webinar, but it also allows us to track and match your generosity. So thank you so much for those of you who have already donated. And that survey will also be your ticket to receiving the replay of tonight's webinar and submit questions for next week. So we're thrilled to be able to bring you Investor's Guide to Thriving, and that's in large part thanks to the support of our excellent partners. And this includes National Bank Direct Brokerage, who supports not only this series, but also Larry's Investor 101 videos on YouTube. If you want to check those out, please make sure to hit the subscribe button and the little bell icon next to it so your phone will tell you the second Larry posts a new clip on YouTube. We've got over 5,000 people following those clips now, so that's great. Here tonight to give you an overview of their state-of-the-art investor platform and how you can get 200 free trades is Iris Nye from National Bank Direct Brokerage.
Thank you, Jared. Hi, everyone. Good evening. My name is Iris, and I'm the Business Development Manager at National Bank Direct Brokerage. I'm very happy to be here tonight. So a lot of people don't know about the National Bank Direct Brokerage that exists. We've been serving clients for over 30 years now. Our platform and our pricing are actually super competitive in the industry. So before I start my presentation, there's a little disclaimer that I want you guys to take a look at. So basically, it's saying that you're responsible for your own investment decisions. We're not here to give you any advice or any recommendations. Okay, so today we're going to first look at what's technical insight. So this is an award-winning program that we have in our platform provided by Trading Central. So when you log into our platform, if you go to Markets and go to Recognia, this is the program that we use, under Technical Insight, you enter the symbol, or the company name can be a stock or an ETF. It will bring you to this lovely chart that you see. So I know some people who've been following the weekly presentation, some of you might have seen the charting system that you can do on a platform. Now, for those of you who like to do your own analysis using the charting system, great. But for those of you who like to have something that's already pre-made for you, this is something that you're looking at. It's already broken down in different technical events for you. So all you have to do is enter the symbol or the company name. So in this slide here, it shows an example of Suncor, right? You can see there's short-term, intermediate term, and long-term. So we're looking at the intermediate term here, and you can see the different events. So let's say if you want to take a look at the classic pattern, where you click on the classic pattern, it tells you, okay, so what is top triangle? The value, the closing price, the target price, right? And if you click on read more, you can actually take a look at what it means. What is top triangle? So you can actually learn and analyze the stock at the same time. So we're going back to the intermediate term, so you can see how it compares to the industry and the index. So far you see it's bearish. Now, if you want to see, okay, I want to see something bullish, how do I do that? Well, you can use our filter on this slide here. It shows you can use the filter here in this slide. You see it's Canada, right? We're looking for bullish opportunity, okay? And for stocks with options, classic pattern. In this slide, it doesn't show, but we picked stocks that are over $15, right? So you can see a list of all the stocks that match the criteria that are bullish, okay? So we're going to take a look at Air Canada, which shows on the next slide here. Sorry, go back to the previous slide, I think. Yeah, so this is the one here. You can see it's a weak bullish evidence, and same thing, you can see the classic pattern, like continuation wedge, and you can see the closing price and the target price for Air Canada. So for this one here, on the next slide here, you can see that you can actually set an alert and a watch list as well. So we'll take a look at the alert section. So you can get alerted. So we will get an email if you set a price alert, and also the technical event opportunities. Here, the slide shows the watch list, right? So you can add these companies, these stocks or funds in your watch list, and it shows you the support and resistance, the technical insight for short-term, mid-term, and long-term. Okay, so this is not only there are so many places that you can look at on our platform. Now for technical insights, you can either go to the market where I showed you, or you can go to get a quote, search the company, and you can see the technical insight as well. So there are two places where you can come to the same information section. So it's very easy to find all of this information. You won't be able to miss it. Now, for those of you who haven't attended our presentations before, you might like this offer. So we are the only brokerage that offers zero commission on all of the Canadian and US listed ETFs. That's right, it's all Canadian and US ETFs, buying and selling for free as long as you trade over 100 shares online. Okay, how about for stocks? Now for stocks, the slide shows that starting from the left column, if you are an active trader, meaning you trade over 100 times per quarter, you only need to pay 95 cents for stocks. And then for options is plus $1.25 per contract, minimum $8.20. If you are a young investor or you know anyone who is under the age of 31, they get 10 free trades a year. Okay, after the 10 free trades, it's $4.95 per trade. So it's 10 free trades a year, not in total, but every year they get 10 free trades. So this is the best young investor package we have right now in the industry. Okay, if you have a National Bank account, it could be a checking account, savings account, or a line of credit linked to your brokerage account, you only need to pay $6.95 per transaction. Okay, how about the free trades that Jared mentioned in the beginning? So if you open the account, this is for brand new NBDB clients, National Bank Direct Brokerage clients. If you open the account before December 31st and enter the promo code LarryFall2020, you get 200 free transactions for your first year. Okay, so you can open the account online, or you can go to the branch to open the account, or you can call our customer service to get the account open, or you can always contact me. So this presentation will be sent to you, so you will have all of the information. Feel free to contact me or our customer service at any time to have the account opened, or if you have any questions, feel free to reach out to me. That's it for me tonight. Thank you so much. Again, have a great night, everyone.
Thanks very much, Iris. Well, we're very grateful for the partnership we've had with BMO ETFs since 2009. They're the original and premier sponsor of the Investor's Guide to Thriving, and BMO continues to lead the Canadian ETF industry offering an ever-increasing array of innovative ETF tools to help you grow your portfolio. Here to show you a few examples is Erica Toth, ETF specialist from BMO ETFs, who will show you how to get Z-Paid with ZPay.
Thank you so much, Jared. I appreciate it, and thank you, Larry, for having me on the show. The slides actually that I was going to talk to today were in regards to the S&P 500 and 400 and 600. So I don't know if there was a bit of a miscommunication there. Jared, are you still with me?
Oh, that's okay, Eric. I'm sure that'll be fascinating as well.
Okay, perfect. I just want to make sure that I have the on the slide deck here. So first of all, just wanted to say thank you. As Jared mentioned, a bit of background on BMO ETFs and what we bring to Canadian investors. We've been the top selling ETF provider in Canada going on 10 consecutive years. So now we're $70 billion in ETFs under management and the second largest provider in Canada. And then part of that is thanks to our work with Larry and his team over the last decade. And part of that, of course, is thanks to the support of investors. So thank you all for that. Also, we've put a lot of emphasis on investor education, on tools, and on support. So I would invite you to check out bmoetfs.ca. That's the Canadian ETF Dashboard for information on news, on flows, on reports, trade ideas, and also ETF comparison tools. So we have brought a lot of innovation to the market. We're now the largest provider of fixed income ETFs in Canada, the largest provider of smart beta ETFs in Canada. So in other words, rules-based ETFs such as low volatility, quality, and dividend ETFs. We're the largest provider of options-based ETFs. So that would be the covered call ETFs, the put right ETFs, and the premium yield ETFs such as ZPay. So those are great tools to generate some extra yield in this low rate world that we're living in right now. And we also happen to be the largest provider of ETF-based funds, such as the 3 tactical funds that Larry, of course, manages for us. So moving on to the next slide. Why should an investor consider ETFs as a building block in their portfolio? So to go over some of the key reasons that make them really fantastic tools for investors, first of all, they're extremely low cost. Second of all, they're a great way to achieve diversification, really in any size account, so even for smaller investors. They're transparent, so you know exactly what you're holding. Major providers such as BMO post a list of all the underlying stocks and bonds in the ETF on a daily basis. They also give you choice and flexibility in terms of currency. So you can buy an ETF, for example, on US equities that's hedged to Canadian dollars. If you want just the stock return and not the currency return, you can choose to go unhedged if you want the US stock return and the US dollar return, or you could buy in US dollar denominated units, even on the TSX. So another huge benefit of ETFs to investors is that you can really pinpoint and be specific about the exposure that you want to access. So today what we're going to do is we're going to provide some information on some different ways to access the US equity market. So we're going to talk about the S&P 500, which most of you are likely already familiar with. We're going to talk about the S&P 400 and the S&P 600. So the S&P 500, of course, is the large cap index for US equities. The S&P 400 is the mid cap index, and the S&P 600 is the small cap index. So as I mentioned, the S&P 500, likely everybody on the call is already familiar with that, but not everybody is necessarily aware of the 400 and the 600 as access tools. So we're going to talk a little bit about these indexes, how they're constructed, and when you might want to consider one versus the other. So here are a couple holdings in the S&P 400, just to give you an example. There's Etsy within the index. That's, of course, the online sales platform for small businesses and artists. There's also FactSet, which is an information and data provider to financial services companies. In the S&P 600 index, you will find companies like Macy's, the department store, and also Yeti, which produces outdoor equipment and gear. So that brings me to my next point. When you're considering mid caps or small caps, the exposures can be very, very different from one market to another and from one index to another. So a really good example is if you look at the S&P TSX Small Cap Index here in Canada, there's 199 holdings, and the median size of each of the companies within that index is about $550 million. But it has a very, very heavy concentration in materials and in industrials. So those two sectors alone represent almost half of that index, of the S&P TSX Small Cap Index for Canada. And the top 10 holdings represent 20% of the total index. The S&P 600, though, when you go to the US for small caps, that is 600 holdings instead of 199. And you're looking at a median market cap for each of the companies, about $1.1 billion instead of $550 million. So about double the size of the companies in the Canadian small cap index. You're also looking at very different sector exposures, and it's much less concentrated. So you tend to have a lot more industrials, technology companies, a lot more financials, but also a lot more consumer discretionary. So remember how I mentioned a moment ago the S&P TSX for the small cap index for Canada? The top two sectors, materials and industrials, are almost 50% of that index. So here it's a lot more diversified across the industries. And also the top 10% of the index only make up 5.6% of the total weight instead of 20% for the Canadian market. So these tools are an excellent way to diversify for a Canadian investor. So to give you a little bit of perspective from a Canadian investor standpoint, I find it's really helpful to illustrate when we're looking at the US mid-cap index, the S&P 500, that has a total market cap of $1.8 trillion. So that is the size of the entire Canadian equity market, just for comparison purposes, to put things into context there. And when you're looking at the S&P 600, which is the small cap index for the US, the total market cap of that index is just shy of $1 trillion. So it's $800 billion. And that equates to the entire size of the equity market of India, the entire equity market of Taiwan. It's bigger than the equity market of Hong Kong. So just to give you some perspective, how it compares to other markets globally around the world. Now, some of the top holdings in each of these three indexes that we're talking about, they provide you very, very different exposures. So the S&P 500, that's the large cap index, and it tends to be very concentrated now, especially in mega caps. So I'm going to touch on the levels of concentration because they're the highest they've been in 40 years, very concentrated, especially in the top 5 names. These are household names. Everybody is familiar with these companies. So we're going to discuss some of those names in the next few minutes. The S&P 400 and the S&P 600 provide you with higher growth potential and also better diversification for your portfolio. So we'll talk about the rationale shortly and when you would want to look at one, the S&P 400 versus the S&P 600. So talking a little bit about the sector exposures now, as I mentioned, these US market indexes are really, really good tools for Canadians to help diversify their portfolios. The TSX, of course, is very concentrated in banks, very concentrated in energy, very concentrated as materials. So as Canadian investors, we're very well aware of this, and our market tends to be really cyclical. But the US indexes have a lot more consumer discretionary, a lot more technology, a lot more healthcare. And these mid and small cap indexes that we're talking about tonight, the 400 and the 600, tend to give you more consumer discretionary, more real estate, and of course, more industrials as well. The S&P 500, on the other hand, which leans to the large and the mega caps, tends to give you more so those big tech names and more healthcare. So let's move on. Let's talk about some of the reasons that an investor might want to use the S&P 600 index. So that's the small cap index. Now, over the very long term, when you invest in small cap indexes, you tend to have a higher growth rate over the very long term since you are taking on more risk with the small caps. It is also pure play on the US economy, a more pure play, since a higher percentage of the revenues of those companies come from within the US. So if you look at the S&P 500, that tends to be dominated by larger multinationals. So it's a higher percentage of sales of those companies and revenues that come from overseas. So the S&P 500, roughly 68% of the company's revenues within the index come from the US, but when you're looking at the mid caps, that rises to 72%. And when you're looking at the small caps, it's close to 80% of those revenues that are generated within the US of the companies within the S&P 600. And when you're looking at that small cap index at the S&P 600, it's also really important to note the higher quality bias versus some of the other small cap indexes out there. So if you look at, for example, the S&P 600 versus the Russell 600 small cap index, there's very different eligibility requirements and rules. So in terms of the S&P 600, there's an earnings requirement. So the companies, to make it into the S&P 600 small cap index to begin with, have to be profitable. So the companies have to have a most recent quarter that has positive earnings, and also the sum of the 4 most recent quarters has to be positive. So if the company is not profitable, they won't make it into the index. That's a really, really important criteria. There's also a rule for the S&P 600 regarding IPOs. So the companies would have had to be around for 12 months. We call that IPO seasoning of 12 months. And with the Russell, there's actually no rule about that. Within the S&P 600, there's also rules regarding liquidity and market cap requirements. So if we're talking about the S&P 500, that's the large cap index, the market cap requirement is about 8.2 billion and up for each company. If you're looking at the 400, which is the mid caps, that's 2.4 to 8.2 billion. And if you're looking at the 600, which is the small caps, it's $2.4 billion and up. So if you're comparing the S&P 600 index, which is the small cap index, 2.4 billion is the requirement, versus the Russell index for their small cap index, it's $30 million. That's a pretty big difference those in terms of those inclusion criteria. And it's actually resulted in huge outperformance of the S&P 600 versus the Russell 200 going back over 30 years of data. So we'll send the slide deck out. We'll make sure that everybody gets it. But if you look back from the beginning of 1994 up until mid-October, you're looking at a total return of, it's actually 1,136% for the S&P 600, and for the Russell, it's 790%. So it's a huge difference. It's about 350% difference between the two indexes on that almost 30-year period. And that's because of those rules that result in a higher quality bias for the S&P 600 for a small cap index. Now, what about the mid caps? We mentioned the S&P 400 as well. It's also less concentrated in the top names than the S&P 500. Now, the mid caps, they've already proven their staying power by moving up a market cap range. So these companies have already proven that they have better access to capital than their smaller cap counterparts. We also consider it sort of a sweet spot because there's a higher probability of the companies within the S&P 400 of getting acquired. And now, due to a lot of the instability that's been brought on by the pandemic, we're really likely to have heightened M&A activity probably for the next couple of years. So this might be one index that you'd want to be aware of and have a look at. So as I mentioned, I did want to touch more in detail on the concentration levels in the S&P 500 currently, because it's at the highest point it's been in 40 years. If you look at the end of last year, at the end of 2019, there was roughly 16.8% in the top 5 names in the index. But now, as of yesterday's close, that's risen to 23% of the entire fund. That's within the top 5 names of that index of the S&P 500. So it's become very, very concentrated. The weighting of the IT names in the S&P 500 has gotten, it's the highest it's been. So that's definitely something to think about going forward, and a reason to consider maybe diversifying your portfolio and perhaps using either the S&P 400 for mid-cap exposure or the S&P 600 for small-cap exposure. So with that, I'd like to say thank you so much, folks, for listening. I'm really sorry about the mix-up for the slides, and I'm going to pass it back to Larry. Have a great evening, and thanks again, everybody.
Thanks very much, Erica. You you called it the Russell 600, the Russell 200. It is the Russell 2000, just to be clear for everybody, so there's no
sorry
confusion.
about that. No, I meant the S&P 400, the S&P 600, and the Russell 2000.
No
Sorry
worries, no worries at all. You know, we're counting down to E-Day, so I've got a couple interesting charts this week. We're gonna do our election review and countdown to melt down or melt up, perhaps, and we'll talk about a couple scenarios. And as much as I love ETFs, and I love ETFs, I called my company ETF Capital Management for a reason, not Larry Berman Capital Management, is because I think ETFs are elegant and all about the future of investment management. The concentration in indexes is a challenge. It really is. And as Erica pointed out, as of a couple of days ago, you know, the top 5 names make up a huge part of the index, and the top 20 names are 50% in the S&P 500. So increasingly, we're getting less and less diversification benefits, oddly enough, by playing some of these ETFs. So I want to talk about splitting up the indexes and looking at option strategies and why ultimately I love ZPay as one of my favorite ETFs that I worked with BMO to design. But first, I came across this chart this week in a Bloomberg article, and I felt that I had to share it and talk about it with you. And this is a screen that was done by Bloomberg, where it basically said, show me the assets and the liabilities and where they're negative for all the companies in the S&P 500. And you can see that today, 5% of the S&P 500 are technically bankrupt. Their liabilities exceed their assets. And over the last number of years, this has been increasing. But it's been possible because of the easy money policies of the Fed. What these low rates are doing is making it possible that these companies that otherwise should be bankrupt and out of business can keep going. And I think that's a bad thing. The Fed calls it improving financial conditions. When the Fed goes out and buys high yield bonds and credit spreads contract to the point where they don't reflect the reality of the bankruptcies that are coming, this is a big moral hazard. And I think this is going to be part of the marketplace for years to come. Sad to say, you know, you've heard me talk about debt and all these concerns that I have about asset markets for years now. And I think it's only going to increase, sadly. So this is something to think about. The quality of the average company in the S&P 500 is one notch above junk status, right? It's literally on the BBB minus category. And to me, this isn't fundamentally healthy. And the increasing size in fewer and fewer companies speaks to the inequality that's developed over the last 20, 30, 40 years. And we see it in the presidential election. We see it in the K recovery, where the markets look okay, but Main Street isn't, and so forth. And so I thought that this was you know, an interesting chart. I wanted to share it, and I think it should be on your radar. The next chart I came across this week, I think, was very telling as well. And as all will know, a huge percentage of the grain crop, corn in particular, is used in ethanol. Ethanol being, is it 10 or 15% of the feedstock into gas cars. And one of the narratives for Trump and the states that support Trump, when you overlay this graph with the one I'm going to put up in a minute that looks at the election and which states are red and which states are blue, this is an underlying theme, and why Trump wants China to buy corn and wheat from the US has a lot to do with the ethanol trade and energy markets in general. And what I found interesting in the last debate was how Trump got Biden to talk about this in particular. Because as you see here in Pennsylvania, Michigan, and Wisconsin, and even Minnesota, this is big. This is very, very big in terms of the rural population that drives this. So let's overlay the election map. And I want to talk a little bit about this because you can go into 270 to win. And I played with the swing states, and all the swing states I gave to Trump, which were Pennsylvania, Michigan, Wisconsin, Minnesota, North Carolina, Texas, Georgia, and Florida. If Biden wins Florida on election night, and assuming all the polling in these other states are accurate, and I believe them to be accurate, Trump needs to win every single swing state plus flipping Minnesota to win. So on election night, if the Democrats carry Florida, it's over. And we're going to know that probably by 9 o'clock. So Florida split into two states, which is very interesting. So the first part, if you drew the timeline down, you would cut off the Florida Panhandle. So that's in the central time zone, which has Tallahassee, and a lot of that population is red voting, where the call it Orlando and South is much more Hispanic and traditionally much more Democratic leaning. And that's a big split. And it's a separate time zone, so the polls close an hour later. So I think what we're going to see on election night is from the 8 to 9 hour, Florida's probably, with all their mail-in voting and they count all the ballots, is probably, if the polling is even close to being correct, is going to lean Democratic. And then we're going to get the polls open at 9, and that's going to swing the other way. And then we'll probably know by 9 o'clock or 10 which way Florida is going to go. But if Florida goes that way, Trump's got to sweep everything else, and it just seems very unlikely. So again, I'm a statistics guy, I'm a policy guy, and I see the probability of Trump winning very, very low. But if Trump wins Florida with 29, he doesn't have to win Pennsylvania as long as he wins Michigan, North Carolina, Georgia, and Wisconsin. And he doesn't have to win Wisconsin and Michigan if he wins Pennsylvania, Georgia, and North Carolina. Right? You just do the numbers. Like, Trump can win in a number of different ways, but he's got to win Florida, and then he's got to win Pennsylvania and one of Michigan or Wisconsin. That's the only way. So it's possible, but it's not probable if you believe the polling. Now, the difference this time between 4 years ago was the silent Trump vote. Going into election night, something like 12 or 13% of the population was undecided. meaning they would tell the pollsters they don't know. Last time, most of that went for Trump. Now they're sure, right? Because the undecideds, depending on the state, is anywhere from 3 to 5%. And it's such a, and if all of that goes for Trump, then he's still behind in Wisconsin and Michigan, and Pennsylvania's a toss-up. So there are a lot of scenarios here, but he's got to win Florida. If he doesn't win Florida, we probably have a president on election night, which would be Joe Biden. And then certainty comes into markets. Now, who wins the Senate, right? And the Senate race, of course, is very, very, very tight. A blue wave means 55 seats for the Democrats in the Senate so that they can pass anything they want in terms of spending. If it's 50, 51, it's still not going to be a gargantuan spending bill, but it's going to be what Nancy wants in terms of 2.2, 2.4 that the market expected was going to pass, not 3.2, 3.4 that was their original HEROES Act that they passed months and months ago that Mitch wouldn't take up in the Senate. But if the Senate stays GOP and Mitch is in charge, they're still not going to be able to pass a spending bill that is much more than $1 trillion, and the market would be disappointed on that. So the number of outcomes are still very, very unlikely. But if Trump carries Florida and Pennsylvania is close, initially it could tilt towards Trump because a lot of the mail-in votes in Pennsylvania, Michigan, and Wisconsin can't be counted until election day. And according to the state people who are running the elections at the state level, they say minimum 3 days before we can count all the votes. So in the right scenario, it's very possible we don't know who the president is. Trump declares victory because he's ahead in Pennsylvania and maybe in Michigan. But once the votes get counted, we know that 75, maybe more percentage of the mail-in votes are going to be Democratic. And then to what degree does Trump take that to the courts to fight it? And he's going down kicking and screaming, I can guarantee you that. So we have the possibility of several weeks or longer of uncertainty after the election, but there is a possibility, I would give it 25 or 30%, that we get a sweep of the Democrats on election night. So govern your portfolios according to that. That's what I'm going to be doing. So where I've got bearish bets, I'm going to have some positions on where I can get some upside if the markets love it. And we're going to do that with option strategies. So I'm going to talk a lot about option strategies tonight, but I do want to look at some of Biden's policies. Came across an article this week that was put out by the Tax Foundation. This is a nonpartisan foundation, and they took Biden's tax policies and they put it in context of every other tax hike we've ever had. I would point to the bottom of the chart on the right. The Trump tariffs of the last few years is actually one of the biggest tax hikes the US has ever seen historically, and you can see them all listed there. But this current Biden tax plan in 2021 would mean a net tax increase of 0.68%, and roll that over into 2022 up another 1.52%. So we are looking at pressure on margin, pressure on spending, but the vast majority of those tax hikes for individuals are going to be on individuals with incomes of 400,000 or up, which is the top 1%. That actually is not going to hurt spending and consumption at all. But according to them, it would be a net equivalent, those tax hikes, of a hit to GDP of 1.62%, and all the rising wage rates, etc. And they translate into full-time equivalent job losses. And so Biden's policies, factually, according to tax-based analysis, is going to cost the US jobs, offset by the number of jobs that are created by all the spending in the green areas and in the infrastructure and so forth. But from a pure tax perspective, that is the impact. And on corporate profit margins, something like 10%. So an unwinding of the Trump tax cuts. Now, to the extent that they're able to pass a capital gains tax increase, they're not going to do that probably until 23 or 24, after the midterm elections in 22. That would be the timing for capital gains tax. But anybody who's in fear of that at some point and wants to pay a lower tax ultimately, there's going to be some selling around that. I don't think we need to worry about that from a tax perspective now and for the next year or two. Okay, so that's my spin on it after reading a lot of analysis this week on the tax implications of a Biden administration. Same chart I've shown in the graphics, folks, every week that's gone by since we've started these. I think we're in week 4 now of our virtual Berman's Call Roadshow, Investor's Guide to Thriving. And this, to me, remains the biggest fundamental problem with portfolios that we are going to have in front of us for decades. And that is your guaranteed yield on a traditional 60-40 balanced portfolio has never been lower. And so to extract extra value, you need to look at asset allocation. You need to look at different areas. The fixed income part of portfolios, I believe, are impaired for a long period of time. If you want to benefit from fixed income, you need to add duration, which are long bonds. And while I like those at 3% and 4% and even 2 and 2.5%, because I was telling people to buy long bonds the last few years, the current yield is at a place in the 10-year and in the long bond where the risk factors in using bonds to protect your portfolio have never been higher in terms of volatility to your portfolio. So there's no more safe bond yield that you can put away and forget. And the entire world of fixed income after inflation has a negative real return for you. And that, of course, is wildly bullish. So I want to talk about some factor investing tonight. I want to look at opportunities in what's called quality companies. And as it turns out, companies with good income and good balance sheets are the ones that have been leading. And so one of the benefits of indexing is you get a lot of great companies because the bigger get bigger. I do think under a Biden administration, there's more antitrust issues where some of these big companies have their business models at risk. We saw some hearings this week on Rule 230 in the internet bill that was put forth years and years ago. And I think they're going to attack that. I think there's going to be more significant antitrust action on a lot of these big tech companies, which means the multiple's going to contract at some point down the road. I don't know when, maybe it's starting already. But when I look at a basket of quality ETFs, one of my favorite ETFs that I'm going to use in the future and don't have any of today is ZGQ. But what I want to show you today is my approach and what they do in the ZPay ETF, and what I've just launched a new fund for our clients to do, which is very similar to what we do or what BMO does running ZPay. Okay, so I want to lift up the hood and take you under, and very simply, in the next 15 minutes, look at how I look at some of these. And I'm just going to take the top 3 names: Apple, Microsoft, and Taiwan Semi. I'm going to talk a little bit about their fundamentals, a little about the technicals, and how I go about thinking about wanting to own these things. So obviously, the simplest thing we do as technical analysts is look at a chart. I know historically that Apple has traded in a multiple between 15 and 20 for the last 25 years. And that, to me, is the long-term norm for the stock. Today, Apple's trading over 30 times earnings. So when they do what they did today and miss on an important metric like their growth profile in China, which has been driving the growth for Apple for years, and they miss by that much, the stock's going to get crushed. So it was down 4 or 5% when I looked last. And so expect some volatility. So off the ridiculous option-driven spike in July and August, we're going to get back to that period there. So you can see the 200-day average is around 90. The PE that's 30 today at 90 is closer to 25. And all that is, it's better. It's not good value. 60 was good. 80 was okay, but a little high. 125, 140, look out, like way too expensive. So Apple's in a corrective mode. And so do I want to own Apple at 111? This is yesterday's close. It's probably trading around there right now, maybe a bit lower actually. So the answer to me is no. I look at the chart. I said, where would I want to buy it if I was trading technically? The gap at 100 to get filled, the 200-day average. So what I did in my yield-based portfolio that works like ZPay is to write a put at 90 for December. So here's the option window. You can see the December expiry date here is the 18th. You can see that on the graphic on the left. And the 90 put at 111 was trading at 134 bid, 145 ask, the last trade at 140. So as Apple was selling off yesterday, I picked my point and I got $1.25 for it. So that means I get to earn $1.25 off a $90 buy point, which is about 1.4% between now and December, which is, call it about 2 months. So I'm earning on an annualized basis about 8%. Okay, and I'm going to keep writing those puts until I get to buy Apple at the price I want to buy it at. So if we get to December and it's trading above 90, I don't buy it. But what is it trading at that point? If it's at 100, I look at it again and say, nope, don't want to buy it, don't like the chart, whatever. And then I look for a put that's going to generate me a yield of at least 6% or more, and I write that put. And if it gets to that level, I get to buy it at that price, and I'm happy doing it. So I'm creating a strategy that's going to pay me a yield of 6% or more all the time until I get to buy the stocks that I want to own, the good quality stocks that are in the global quality index at the price I want to own them at. Now, if I wanted to buy Apple today, I would look at it and say, okay, I like it, right? Can I write a call on Apple to sell it at a higher price that's going to generate me an additional yield of 6% or more? And I will write that call. And if it goes to that price, I get a capital gain and I sell Apple at a level I'm happy selling it at, and I earn an implied yield of 6%. Plus the dividend that Apple pays me while I'm holding it. So it's a brilliant strategy. Market goes down, you buy more. Market goes up, you sell some. The whole time you earn 6% or more. And on average, You're long with a covered call on half the portfolio, and you're writing puts on the other half. So it'll go up to 70 or 80% long when things selling off. So that's good. You're buying low. And when things are rallying, you're selling, so you own less equity. All the time, you're earning that 6% plus. This, ladies and gentlemen, is the biggest holding that I have right now in ZPay. I love it. I love what it does. It's a fantastic holding. It has volatility. The volatility on average is less than the S&P 500. And it's not going to give you all the upside, but you're not owning it for that. You're owning it for its yield and its consistent payout of 6% or more over time. So it's a great yielder. It's not a replacement for your fixed income. It's equity market risk and volatility. But it's equity market risk and volatility that's half of the S&P 500. I love it. I absolutely love it. Let's have a look at Microsoft. So the second biggest weighting, I look at this chart, I say, oh my God, that's a top. Where do I want to buy Microsoft? Wow. Well, I'd love to buy it at 140. I don't think we're going to see that. Unfortunately, we might down the road years, who knows, but probably not any. That's the worst as it got at the peak of COVID when the world thought this was the Black Death. So I don't think we're going to see that. Is Microsoft overvalued relative to its long-term trend? Yeah, so here's a stock that over the last 25 years has traded with a PE in 20 to 25, currently trading around 32. So at 25 PE, where's that? Well, that's around 170, okay? So we're still 15% away from the upper end of fair value, where at 140, we're actually at the lower end of fair value for Microsoft. So what are the risks we're going to get there? I don't think so. But I would be happy buying it at this point, even though it's broken the 200-day average at around 180. So let's have a look at the December options at 180. So currently at 206, I printed this off this afternoon just before the close. It was trading at $2.80 based on where Microsoft was trading yesterday. As Microsoft was declining, I got $3.75 for it when volatility had spiked towards the end of the day. It was higher. And so I'm already in the money. At $3.75, I'm earning a 2% yield off of a 180 price for the next 2 months. And I get to buy it if it goes below that between now and December 18th at my price. And I'm good with that. And if it doesn't get there, I'm going to look through that universe in the ZGQ and find another stock where the risk reward is attractive right now. And I'll buy that stock with a covered call. And I'm going to earn the dividend plus 6% on the covered call position. And I'm going to keep doing that over and over and over. I got over 300 stocks in that quality ETF that factors all these companies in the world that has great balance sheets, great return on investment, great free cash flow, great dividend coverage. Folks, that's quality, and I love it. I love it, I love it, I love it. Let's have a look at Taiwan Semi. Taiwan Semi is going to benefit huge as China dumps demand for Intel chips and AMD and all those other US companies because of the battle with Trump. And not just Trump, it'll be Biden too, because this race with China for supremacy of technology in the world and these companies moving their supply chains around and bringing that back to the US and that is going to be inflationary, but it's also going to mean a Chinese friendly company like Taiwan Semi, even though Taiwan and China, there's issues, is going to benefit substantially. So where do I want to buy Taiwan Semi? Do I want to buy this chart right here, right now? And my answer is no. Where would I buy it? So I wrote a put at 70 and it could go to 65 or 60 even, no problem in a risk-off sell-off. The worst it got was around 45 post-COVID, and I don't think we see that. 60 would probably be my worst case scenario, but I would view that as somewhat temporary. So 70 is my target. I can get a yield for the next 2 months, a little over 1%. And I wrote that yesterday, and I got 80 cents for it on Taiwan Semi. Now, I did other ones. I did Visa, I did NVIDIA, and the list goes on and on. But yesterday was a busy day for us in writing these options, because when volatility spikes, that is the great time to increase your yield and premium on these portfolios. So love ZPay, love ZPay, love ZPay. Folks, please learn how to use options. And when we're done, I think next spring's seminars are going to be about teaching people how to use options. Maybe we're going to do workshops. We're definitely going to do a series of YouTube videos on option strategies. So very excited about the educational aspect of what we try to do. And so I want to show you here ZPay, and there's different versions. So Erica mentioned there's a US dollar version, and there's a Canadian dollar hedge version, and so forth of almost all the BMO ETFs. So the ZPay, ZPAY, holds US dollars in it, but it's priced in Canadian dollars. That is the white line. And so that ZPay was launched in January of this year, and that's what ZPay has delivered year to date in terms of the dividend and the price experience. So up about 5% year to date. Now, the US dollar version, ZPay/U, is the orange line. And the difference between them is what I'm showing you is the experience of the Canadian dollar. That's the yellow line. That's the Canadian dollar currency ETF that trades in the US. And so it's down a couple percent year to date, which is basically the difference between the orange line and the white line. Okay, so know which currency you want exposure in. And I'm comparing these to the red line, which is the benchmark for our global dividend fund, and that is the iShares Global Monthly Dividend Index ETF, currency hedged. And year to date, that ETF is down 24%. So dividend stocks globally have been doing really, really, really bad. And there's much more value in those names. There's much less technology. This is increasingly becoming a very, very difficult market to invest in. And I think you've got to pick your stocks carefully, which is what ZPay does. And again, another reason I love it. So you buy low, you sell high, and you have 2 to 3 times the yield of the broad market. And you can see I'm pounding my fist on this as a great, great strategy. It's not without volatility. It's not without risk, but you can see how it performed relative to dividend stocks in general. And I think that message should resonate with everybody, and why it's the biggest holding I have in my ZZZD portfolio that is not gold at this point, because gold yields me nothing or very little. Just reiterating the list of long-term tech stuff I like. I don't own any of it right now. It's all very expensive. But in this pullback, we're going to be adding this to our growth portfolios. None of these things pay material dividends except for TDIV. And we're looking to buy into TDIV. And I understand BMO is working on an ETF that's going to be focused on global technology dividend payers. Don't know too much about it. They haven't filed papers for it yet, but I know they're working on something in that area. And then learn how to hedge. And again, we'll be talking about more and more about how to use options to do that. So last week I went to the mailed in questions first. Tonight I'm going to go to the written in questions first. and we've got a full half hour here to get through everything. So guys who wrote in, thanks very much. John is asking, can I tell us again about some ideas how to hedge our portfolios, maybe recommend some tickers? HDG is an ETF. Some of the inverse ETFs are the ones to use, not ones with leverage, but single ones. SH for the S&P 500, PSQ for the NASDAQ. Those are good inverse ETFs to use to hedge. Have a look at QBTL. That's a bit of a bear trade there. And I talked about a lot of them, John, over the last number of months here. Do I think A shares is going to do well in the next 6 to 9 months? Well, when markets are volatile, A shares will be volatile, but these are China mainland stocks that are priced at about half the multiple that we see in US markets. So I believe increasingly that A shares are going to outperform. I wouldn't be buying into strength. I would be looking for dips to buy in A shares. Thanks, John, for that. James is asking, I've looked at healthcare ETFs trading on the TSX. I note that a number of them have average volume of trade of only a few thousand units, HIG, Life, XHC. Should I have concern about liquidity of a few units per day trading? James, I would not use illiquid ETFs for day trading. And while, so let me bring my Bloomberg screen in here and just have a look at some of these. Now, obviously, this is easier to look at during trading hours when you have active pricing, but XHC. So let me have a look at XHC. And this is a global healthcare ETF. Keep in mind, so when you're trading a global ETF, I'm going to bring up the chart here, and then I'm going to bring up, add volume to the bottom here so we can have a look at it. And as you can see, the average daily volume is 27,000 shares in this, and so that's relatively thin trading, and it goes up and down with volatility. But generally speaking, 20,000 shares a day. The bid-ask spread in something like this is going to be pretty wide and wider in the afternoon. And you might ask why? Well, more than half the stocks are closed in the afternoon. They trade in Europe. So the market maker can't hedge. And you've got to be very careful about what you own and when you're opening. So, but if you're buying to hold it, I wouldn't worry at all about the trading liquidity. But if you're going to be day trading them, and I think that's what you alluded to here, James, then I would look for ETFs that have plenty of liquidity. So in the US, the most liquid healthcare ETF for trading is XLV, trades on a penny spread on a $100 ETF, and you can trade that all day for as much size as you like. So that's something I would look at there to think about. Richard is asking, is ZZD a good ETF investing inside RSPs? And I would say absolutely yes. Does BMO have something similar to VTI? VTI is the Vanguard Total US ETF, and that is VTI. Large, mid, and small cap stocks all in one place. And the answer is no. You would have to buy the ZUE, the US large cap S&P 500, and the two ETFs that Erica talked about today, the mid and small cap, to equal the S&P 1500, which is basically what VTI gives you. Larry, the price of oil. Larry, the price of oil recently dropped. What's your view on Suncor and Enbridge as a buy for trade? Suncor is a buy. It's a double-fisted buy at these levels. You know, we're back at the lows that we saw at the trough. When oil prices plunged to negative was mid-April. That was this. So it's a strong buy here. However, I think if COVID is bad over the next couple of quarters, which I expect at least through February before we get some relief on the seasonal impact of the flu season, and we're not going to have widespread vaccines by then, then there's a chance that oil prices go back into the mid-20s, in which case there's going to be some more downside pressure here. But I would at least own half of a full position at Suncor at this point. But you can be okay. But recognize that if we start trading below 14, you're going to run a bunch of stops, and people might panic a little bit. And I would look to buy more into that, not less. Suncor and Petrocan stations are not going away anytime soon. And while I believe under a Biden government we'll go faster towards green cars, we're not going to eliminate gas stations for decades. But it's coming faster than you think, folks, and that's part of what's behind some of the relative weakness in these names. So tradable, not investable. And Enbridge is a completely different play on pipelines and gas distribution that has nothing to do with crude oil or greening the world. And it's in a very similar technical setup. And I would say it's a trading buy for sure at this point. Larry, like you, I'm bullish on gold. Do you have a preference? XGD, ZGD in Canada, GDX, GLD in the US. So XGD, let's have a look at some of these. So XGD is a market cap weighted play. So let's look at the chart there. You can see it. But what I'm going to do here is look at the weighting of the stocks in the portfolio so you can see, and then I'm going to compare that against what we see in ZGD. So this has got the healthcare ETF. Why is that? Sorry, XGD. Let me look at it this way, it'd be faster. Look at the holdings. So Newmont is about 18% and Barrick. So you're heavily weighted in the top 3 names, 4 names that are like 50% of the portfolio when you buy XGD. When you buy ZGD, you get an equal weighting. So the mid caps and the small caps are much more important in this portfolio than they are in the other. And if you're bullish on gold, ZGD is going to outperform XGD, and therefore I own ZGD because I'm more bullish. And in terms of the GDX versus the bullion, you're going to get much more leverage to the upside and more volatility owning gold stocks than you are GLD gold bullion. And GDX has a very similar makeup to XGD, Sean. Question here. Why, oh why, are the slides so small? This is fixable if you put some thought to your viewers' ease. I will do that, Lauren. I have not had that feedback before. My screens are quite big. If you're looking at a small computer or laptop, then it is hard to see. But you'll get a chance to view it again and repeat, and you can get a copy of the presentation and look at them in PDF form by filling out the surveys. When is return of capital on ZW, when is the return of capital on ZWB? Where is that going? I hold ZWB, but I never see that coming to me as cash. Where there is return of capital. So I'm not following the question there, Jay. I'm sorry about that one. ZPay dividend is currently quoted at 4.48% on various sites. Is this correct? Well, let's have a look on what Bloomberg tells me. So here's ZPay, and here's the description of it. And when we look at the performance, we see the indicated yield of 5.93%. It's paid out an income year to date of 1.35, which didn't include January because so it's a month behind as it annualizes. So I think this is off a little bit. But when you look at the distributions, so CACS on Bloomberg here shows me the distributions, and it's paying out 15 cents per month, and you can see that here. It's a consistent 15 cents. That's based on a price of $30 where it was issued. So it's 6% on $30. And so the yield is 6% on $30. Now, if the current price is a bit higher than that, and it's consistently paying out still 15, then it's a little less than 6%. Okay, so I don't know what sites you're looking at, but they're wrong. And I hate to say that about other sites, Andre, but that's kind of how I see it here. Okay, got a few more questions here online, and then I'm going to get to the ones that where people wrote in. How is it that BABA ADRs are not on the high quality list when Tencent is? That is a good question. So let me have a look here on ZGQ. And so this is MSCI All Country World Index. And here's the holdings. And so 10 is there in Hong Kong. If I scroll down, well, let me do this. See if BABA is there. It is not. Okay. So the question then is, why is BABA not there? And let's see if I can pull up the ADR and see if I can spot, based on looking at what some of the fundamental drivers are. So profitability is high, it's attractive. Leverage is low. So that's a very good question. Carrie, that's a very, very good question. I think it would be one that would be need to address to MSCI actually. And you can go to the MSCI website, look up quality factor, and it'll give you the criteria for what the company needs to be included in an index. And it's possible that the ADRs don't qualify. It would have to be, a local listing. So if I look at BABA and see what is a Alibaba group in Argentina, Switzerland, US. So I don't see a listing outside of the US depository receipts. And my guess, and it's only a guess, but if Tencent is in there, and you can see actually by looking at holdings that it's not an ADR of 10 cent, but it's actually the Hong Kong holding. So it's very possible, although I see a depositary receipt here. So you know what, I'm not sure of the answer, but that's a fantastic question, Carrie. And I would encourage you to go to the MSCI site and have a look. If I get some free time to do that, Carrie, I'll do that, and I'll mention it on next week's show or something like that. But thank you for that. Okay, so now I'm going to go to the online questions of the people, not the online ones, but the people who have submitted questions and that we have already prepared here. So Wayne is asking, if Biden wins, what effect do I think that will have on the socialist wing of the party and on government policy, and how would this affect markets? So I talked a little bit about the tax part of the Biden administration's plan, but the socialist part, the MMT part about spending and taxing and redistribution of wealth, Biden is a centrist. He's always been known as a centrist. And to the effect that people vote in Congress, because ultimately Congress writes the checks. So if you're seeing more and more senators, more and more Congress people elected that are more socialist than like Bernie, then I think you will see over time more socialist agenda. But you're not likely going to see that from Biden, certainly not in the first term. First-term presidents are very mindful of losing control, especially if they get a mandate. Trump got a mandate in 2016 where he controlled all three parts of government. You know, the lower house of representatives, the Senate, and the White House. And he got nothing done except for a tax cut, which was fine, except he cut taxes for wealthy people and very little for the low end. And he cut taxes for corporations that frankly didn't need it. And I think it was ill-timed, but we can debate that and subject for another day. But he lost the midterm election and the House flipped over. And it is the House that writes the checks. The bills originate in the House and then get vetted in the Senate, and they go back to the House and they go back and forth. And right now they can't pass a bill because they don't agree on how money should be spent. And that's gridlock. And generally gridlock is good. But gridlock is not good in the world we live in when the markets need the stimulus to stay alive. And when they don't get it, they start convulsing like we're seeing now. So we will get spending. It'll be bigger under Biden. The more the Senate tilts towards the Democrats, the more spending they can do. The bluer things are, probably the more spending is going to get done. But they're not going to be raising taxes in terms of wealth distribution, i.e. capital gains and wealth taxes, at least until the midterm elections have passed. But that would more likely be a second term. And I don't believe, at some point, I believe Kamala Harris may be president. So we'll see how that all goes, depending on the health of the vice president. What's my opinion investing on soft commodities, and what ETFs would you recommend? So there used to be commodity-linked futures ETFs based on softs and metals, and I don't think they exist anymore. Goldman Sachs had a bunch of index links. There may still be there. They're very little used, and I wouldn't recommend people use them. So there's no good solution really in the ETF area for soft commodities. So this is coffee, cocoa, sugar, corn, wheat. And the way to play this is basically with agricultural type ETFs. that benefit from higher revenues when the soft markets and the grains in particular are doing well. So, and they would include companies like Deere and Potash and companies that play the production side of agricultural, not the pure commodity side. There are broad-based ETFs, COMB, COMT, that you might want to look at, but those include metals and those include the energies futures as well. So thanks for that, Marco. Currently allocated to 80% CAD and 20 USD. Should I change this? Well, if you ask this question, George, when the Canadian dollar was at 77 cents, almost around 130 traded terms a little while ago, I would have said yes. We're currently sitting at 134. I think we're probably capped around 138. And so 134 is in the middle, 133.33 approximately where it's trading at the moment. Yeah, you can increase your US dollar exposure a little bit here. There's no right ratio, but for me, for the next year, my hedging strategy and portfolios is to be fully hedged at 138, at 128 to be full on US dollars, and somewhere in the middle, I want to get paid premium. And that's kind of how I'm thinking about things. And around 134, 135 range, I'm going to be 50-50 neutral. Jim in Sudbury is sitting on a bunch of cash. Would like to do a little research into some of my favorite ETFs. I've talked about a lot of them tonight. ZPay. Can I recommend a good ETF screener? BMO at BMOETFs.com is a good one. Listen, all the ETF providers have very good screeners where you can get information about which ones work best for you. One of the things I like about the BMO ETF screener is that it has all the ETFs. You can put up the iShares, you can put up the Vanguard, kind of put up the Horizons, and you compare the MERs, you can compare the holdings, the sectors, and so forth. So BMO is a good one, Jimmy. I've watched HHL, ZUH, and Life. ZUH rebounded much higher. So HHL is a covered call overlay. So that's going to give you a very different experience than that. But let's have a look for Roland here and see if I can't bring up ZUH here. So this is a BMO US healthcare hedge to CAD. So that's important. And I'm going to bring up a comparative chart and I'm going to run year to date. And what we're going to do is we're going to look at that, and we're going to look at Life. And then we're going to look at HHL. And we'll look at them on a total return basis, all three of them. So ZUH went down the most, the white line. It also went up the most. There's no option strategies there. Life is a global ETF, not just the US. So you've got exposure to other places in the world and other currencies, and very possibly a lot of those companies haven't done as well as some of the US names. ZUH is equal weight, so the small and mid cap names have done better than the large cap names, and that could be a factor in terms of the differences between all of them. ZUH is hedged, and Life and HHL, I believe, are not hedged. So those are all the different things rolling between all of them. And, so I hope that gives you some thought as to why and you would want to own, any one of those. Recently took advantage of the offer for some free trades and what. So that's great, Roger. I went back over notes from past webinars and noted 3 possibilities to go to cash for some assets. ZST, ZBBB. So ZBBB or BBB bonds, that's not cash, and I wouldn't use that for cash. ZST is much more cash-like. I'm okay with that as a cash holding. DANC is not cash. It's a market neutral long-short portfolio. So let me throw DANC in here. This is not a cash-like holding. This is a hedge fund long-short portfolio. And when we look at the returns, it gives you an experience that looks like cash, but it's not. Okay, when you compare that to a ZST, it's not cash. Okay, it's long short portfolio, and they've got to do a good job being long and short. So if you look at what they hold, oh, that's bizarre why it shows up that way. I guess that is weird. It's not showing me the holdings here. I think you would have to go look at their website, unfortunately, to see the holdings. I'll look at one other way that I might be able to get a look at the holdings, but let's have a look here in terms of this. Yeah, so you can see that it's got 180% exposure, and that's because it's long and short in terms of what it has in the portfolio. So it looks like it might be a wrapper on some Desjardins fund that they run, and they've converted it into an ETF or something like that. But what they're going to do here is they're going to do something like this. So Canadian banks, for example, they're going to be long Royal Bank, let's say, and short, let's not use one of our sponsors here currently, and let's look at Bank of Nova Scotia. And they're going to look at these, and if they're good, they're long Royal Bank and they're short Bank of Nova Scotia. Well, the difference between those two year to date, it's like 15%. So if that's the trade they had on, they made money. But if they were long Bank of Nova Scotia and short Royal Bank, they've lost 15% this year. You know, let's look at TD as another one of our current non-sponsors, and we'll bring up the other one just for fun, and look at Bank of Commerce. And so, you know, if they were long CIBC and Royal, those are the best two so far this year, where TD and Bank of Nova Scotia have been the worst. But I don't know that to be true. I'm just saying. And then they would be long Suncor and short Synovus and so forth. And they would be long short stocks. So it's not market neutral. We're coming up on time here. Let me see if I can get to a few more questions a little bit quicker. Since the US election is around the corner, we already discussed the effect of the stock market. Can we hear some debate on the Canadian economy? Diana's asking for. So let me focus on that next week. I've seen the question. I'll give you some thought on Canada. But Canada is spending far, far more money than the US is in terms of recovery as a percentage of GDP. And the Bank of Canada is monetizing way more than the Fed is proportionally. And they spoke this week about pulling back a little bit on that. And that would be a negative for the Canadian dollar. And they also are open to negative interest rates, according to what Tiff Macklem said yesterday. So I think that's bad. So listen, I'm not a fan of Canada. I think we don't have a great economy. We have way too much emphasis on commodities. And the winners of the future, to me, in terms of growth or technology and healthcare, now we have a lot of financial services, and that's great. That'll be a big winner too. but not in the short run, where technology is expensive today and we have very little, and healthcare we have very little, but a lot of marijuana. So I think Canada's a bad market in general, and I think the Canadian economy is structurally weaker than many others in the world. Last week I mentioned ZGQ as a growth tilt. You can see some of the names that we looked at this week. Do you recommend exposure to value? So let me have a look quick. Are there any other value names? So you can use the BNS screener, but if I look at, I screen Bloomberg here and I say value, CN for Canada, and ETF, I have a list here. So you've got a CI first asset, value international, you've got a Canadian value here, and so forth. So here's a list of them. Take a quick look at that, Rob, if you're online here, and to see, but the VVL is there as well. Okay, so there's a few. These should all be on the BMO screener. So to go to BMO ETFs and have a look. Can I comment on long bonds? Yes, very quickly. We're seeing a deleveraging in risk assets and risk parity funds. Bonds are being sold, gold is being sold, and equities are being sold. We saw a similar move. It's not going to be as great, but as risk comes off, these assets are getting sold off. There's also a backup in yields because even though the Fed's going to buy these, if we get a blue sweep and we get trillions of new spending, bond yields are going to have to back up a little bit. So I would buy the backup for sure, but I'm avoiding it now, and I do not have any positions in long bonds at the moment. US 10-year test 1%, and I think you're buying with both hands. And the last question of the night before we wrap here from Ryan, would I please describe my current option hedging strategy as for protecting portfolios from any US election-related market corrections? All my BMO public portfolios are fully protected at the moment with puts on the S&P 500. And to pay for those puts, I've written some calls, and that will give us a great volatility hedge, which I expect to lift at some point in the days or weeks following the election and expose the portfolios to a recovery rally based on the tremendous amount of stimulus that's coming next year, no matter who wins the election. Thanks to everybody. Hope you learned something this week. Make sure that election is on your radar next week, and almost certainly we'll have a lot to talk about in the wake of the election next week. So be back with us next Thursday, and please, if you're interested in having a portfolio review, have a look at etfcm.com. If you are interested in our new stock portfolio that looks to do what ZPay does and has some added features, give us a call there. If you're looking at what we do for BMO in the 3 funds, ZZZ portfolios, if you're interested in independent financial planning, U-Potential, and if you're a financial advisor, have a look at the Q Wealth platform. It might be something for you. Please, if you haven't already, thank you for those who have donated to Sick Kids. Click the links in the follow-up email that you're going to get, and my firm and I will be very, very pleased to match your donations. Thank you very much, everybody. Be safe, be healthy, and we'll see you next week.